Great day, team. I am Sam Irwin with the American Military University, and I'll be leading the training today for sensitivity analysis for capital budgeting. To start off, let's briefly review capital budgeting. Capital budgeting is a general process that alters from company to company. The first two steps are investment screening and selection and capital budget proposal. These are the two steps we will primarily focus on in this training. Then comes budget approval, project tracking with reports for expenditures and revenues, and post-completion audit to verify outcomes of the project and evaluate the validity of assumptions made. There are several types of capital budgets ranging from replacement projects to new product projects to general maintenance projects. Every project has an economic life over a certain period, typically in years. Every project has a goal of turning positive cash flows before the end of its economic life to ensure that the project recovers. Now we will discuss about sensitivity analysis. According to Investopedia, in terms of mathematics, sensitivity analysis determines how independent variables impact dependent variables given a set of assumptions. Another interpretation of this is that sensitivity analysis assesses which variables or risks have the most potential impact on a project. So, for sensitivity analysis for capital budgeting, we make assumptions based on our judgment, speculation, and educated guesses to determine the impact from a range of variables to the net cash flow from the project and whether or not the project is worth taking on. As discussed before, capital budgeting is a process. There are qualitative and quantitative steps for sensitivity analysis taken as part of the investment screening step on the capital budgeting process. Qualitative variables is information that is not able to be measured numerically, while quantitative focuses on numerical analysis. After we talk about these steps, we will discuss how risk is incorporated into capital budgeting. The qualitative aspect to sensitivity analysis is identifying potential costs and benefits for variables one is unable to quantify. For example, these variables could be a new company entering the market, impact from technological advances, and speculative impacts to the supply chain, such as the effects of the coronavirus. In many cases, historical data can be analyzed to try to determine the impact that these types of variables may have on a company's growth. In addition to historical data, decision makers are able to analyze these qualitative variables by forming focus groups, follow markets and industries, and track the life cycles of current projects and products to make assumptions to determine whether a project is worth the risk. Decision makers conducting this analysis are stakeholders, and for larger companies are often delegated to marketing and product management groups. The quantitative aspect of sensitivity analysis can build from qualitative sensitivity analysis. Through the use of a company's weighted average cost of capital, 5 capital budgeting techniques are used to determine if a project is profitable and by how much. Payback period determines how long it takes to recover the cost of the project, while discounted payback period includes the cost of paying back the investors. If the period is less than the economic life of the project, it is profitable. Net present value incorporates time value of money, and if it is positive, a company should consider accepting the project. Internal rate of return calculates to find a NPV of 0 and determines the cash flow necessary to break even. Modified internal rate of return is similar to IRR, but its calculation is different because the company assumes a different reinvestment. Now to discuss about project risks. In the quantitative sensitivity analysis, we were using the weighted average cost of capital as a discount rate with the assumption that the company was willing to accept their average risk over time. In the event that the company evaluates a project with more or less risk based on speculation and their judgment, then the company should adjust their weighted average cost of capital accordingly. If the project is deemed more risky, the WACC value should be increased. If the project is deemed less risky, then WACC value should be decreased, and these changes need to be reflected in the quantitative